the CPA of the financial independence community, explains the tax planning strategies you need to know to help you retire early. Here we go. Welcome to the Forget About Money podcast, where we encourage you to take action today so that you can focus on what matters most to you. Today we have Sean Mullaney, also known as the FI Tax Guy. Sean is a CPA and financial planner who specializes in helping clients achieve financial independence through smart tax strategies. We've known each other for more than a few years now, and I think of Sean as the guy who makes taxes more approachable for the rest of us. So thank you for that, Sean, and welcome.
David, thanks so much for having me. Looking forward to this conversation.
Today, we're going to discuss fundamental tax planning strategies, some advanced tax strategies and concepts, and how the financial independence community may be getting it wrong when it comes to taxes. Let's start with you, Sean. You have been a voice in the financial independence community for quite some time. And I honestly can't think of another tax professional that has such focus on the financial independence community specifically. Can you just talk about your role in the financial independence community and what your goal is there?
Yeah, David. So, part of the reason I make content for the financial independence community is financial independence sort of opened or turned the light on for me when it comes to a lot of these tactics. So what do I mean by that? I used to be sort of before I changed my career to a financial planner, I was a bit of a hobbyist when it came to personal finance. You know, back in the day, I would read the Wall Street Journal Weekend Investor, and I'd see, oh, there's an article on the backdoor Roth IRA. Isn't that interesting? Or let's talk about index investing. Isn't that interesting? And it was in early 2017, I found the Choose a FI podcast. And what it did was it said, okay, we have these different tactics out there, 401k contributions, backdoor Roth, index investing, whatever it might be. And it made them a whole, right? Instead of just talking one off about the backdoor Roth IRA and moving on with our life, that's great. Well, what it did was it said, no, there's a goal here. There's a framework here. We put all these things together in some orderly fashion for ourselves, and it makes sense holistically. It's not about a one-off conversation or going down a rabbit hole. It's about putting it all together. And so that's what the financial independence community did for me in terms of the way I approach personal finance. And then, I did a career change in 2018, 2019, became a financial planner. And in order in today's environment to sort of have a presence, you got to produce some content. And I sort of stumbled on, hey, why don't I produce content that's relevant for a particular audience? In this case, the financial independence community. And that was actually inspired by somebody you know very well, Stephen Boyer, your brother. I went to a Camp FI back in 2018, and I was having a conversation with a woman who happens to be the admin for the Choose a FI San Diego group, Jennifer Ma. And we were talking, and it was very obvious I was interested in taxes. And so she said, hey, Sean, why don't you come down here and speak to us? So I went down on a Saturday afternoon or Saturday morning down to San Diego, spoke about taxes and financial independence. And I was doing my career transition at that time. So, midway through that talk, I got the bright idea, well, I did a lot of prep work for this talk. Maybe I could turn some of that prep work into a blog. And that's where the idea for the FITaxGuide.com blog came from. I can't say it was all of this great machination, this incredible, thought that I had. No, it was literally, I talked to some people, they talked to me. I did some stuff, and then an idea came into my head, and not because I'm some grand marketing genius. It was just like, hey, wait a minute, this makes sense. I've already done a lot of the legwork on this. I could probably set up a blog, and hey, it appeals to the financial independence community. So that was a lot of strokes of luck, and people like your brother, people like Jennifer Ma, helping out. They didn't intend for me to have a blog. They just said, hey, Sean, here's a forum. You can come speak to people, hear people, and it worked out really well.
I think that's very interesting about how things evolve for each of us in this community. Somebody attends a Camp FI. Next thing you know, they've got a blog. They're starting their own business. They're getting their spouse on board. They're making significant changes in their financial picture for the better. It's pretty amazing how it all works out. And I feel like we're all on this kind of ride together in a very positive direction. And thank you for all your help. And I'm glad that you took action to start your blog, as well as, I don't know how many times you've spoken at a Camp FI now. I know personally of at least 3. I'm not sure if it's more than that, but probably.
I think it's four
So
times. It's each of the
yeah.
last. I've been sort of lucky to be able to go to Camp FI each year. I think it's every year that Stevens held one, other than 2020. I
Mhm.
have gone to a Camp FI, and I believe I've spoken at the last 21 through 24. So that's easy math, four times. And it's been great. Really enjoy them.
So right now we're talking about the financial independence community specifically, but taking a step back to the broader personal finance world, taxes are something that we all need to be very aware of and at least have some kind of cursory understanding of how it impacts and how our actions can impact taxes and our overall net worth growth over time. If you were going to provide a list of your top 5 tax planning strategies, what would they be and why?
Yeah. So, David, I would step back even further from that and say, we got to think about strategy and we got to think about tactics, right? And if we talked about 5 tax strategies, we might be here all day. I think for the audience, I'm going to give you one strategy and then 5 tactics that I really like for many in the audience, right? We're not giving individual advice here, but I think we're going to provide some good educational knowledge. So the first thing is the strategy. I think for most in the FI community, the overall strategy is let's use retirement accounts to limit total lifetime income taxation, right? Basically, it's a fancy term for that is tax rate arbitrage. What we're doing is we're saying, hey, we have these high earning years at work. We're saving up. We're at our highest tax rates in terms of marginal tax rate. So we take our deductions then as best we can get them. Then we get into a retirement that's somewhat early by conventional standards. And now we're cooking with gas. We have abilities to manipulate the tax code perfectly legal, right? This is all about legal, very bread and butter tax planning where we say, hey, we're early retired. Guess what? We've got low taxable income. We're now going to cook with gas in terms of maybe Roth conversions, charitable giving, that sort of thing. Okay, so that's the overall strategy. Let's use these retirement contributions to limit total lifetime income tax. Well, how do we do that tactically? I'll give you 5 tactics that I tend to like. The first one is the traditional 401k. And this one comes in for some heat from some other personal finance content creators out there. They say, oh no, these traditional 401ks are infested with taxes. My work yields, hey, you know what? They're not all that bad on the out end. And the thing is, people forget the tremendous benefit when we're saving for retirement. We are taking home a tax benefit, federal and possibly state, at our highest marginal rate. That is such a very powerful benefit. And that actually leads me to my second tactic, which is taxable accounts. People say, oh no, taxable accounts, they're taxable. That sounds bad. Well, we live in an incredible environment, qualified dividends, long-term capital gains. Many of those can go at a 0% tax rate in retirement. So why not build up some of those things, live off them first in early retirement? And it turns out your tax burden can be very, very low. And you can do some additional planning where you do Roth conversions. So I'd say first tactic, traditional 401k contributions while we're working. Second tactic, taxable accounts, just building those up for an early retirement. The third tactic would be the Roth IRA while we're working. And this could be a backdoor Roth IRA where we do a 2-step transaction to get around something called a pro rata rule, or it could be just a regular annual Roth IRA contribution. I like Roth IRAs for a number of reasons. One, they can be an emergency fund if we need to. We don't like to use it as an emergency fund, but we can. And then second, we generally don't sacrifice in most cases, not all cases, but most cases, we don't sacrifice a tax deduction when we do a Roth IRA contribution. The same way when we do a Roth 401k contribution, we're sacrificing a tax deduction. And then the fourth tactic I'll mention is the health savings account, right? This is where we are signing up for a high deductible health plan. So, oh, by the way, we're lowering our medical insurance premiums. That's a good outcome. And we're taking a deduction for contributions into our HSA. So that's great. And then when we retire, we can take that money out tax and penalty free because we have old unreimbursed expenses or we have current expenses and we just pay for them that way. So the fourth tactic would be the health savings account. And then the fifth tactic would be Roth conversions. And this is where I and other financial planners and content creators very much align, right? This is the flavor of the day. Get to retirement, especially an early retirement, and do these Roth conversions. Even in a conventional retirement, there could be very, very powerful opportunities, because what you're doing is you're whittling down that traditional retirement account at your timing, not the government's timing. You're saying, hey, you know what? I have an artificially low tax return this year. So instead of, one thing I think most of the audience want to avoid is filing a negative tax return, where your taxable income less your standard deduction is a negative number, right? That's an indication that before year end, don't let that happen. Do a Roth conversion, at least get back to zero. You might want to do more, by the way. You might want to do a lot more, by the way. You got to do your own analysis, but usually a negative tax return is something to be avoided. So I'd say those would be my 5 tactics. And we can, David, as you want to, we can explore any or all of those in more detail.
I remember a conversation that you had, and I believe that the overall conversation was about how our habits themselves can reduce how much taxes we pay practically in our daily lives. So let me ask specifically, maybe you'll talk about this. What are some ways we can reduce our taxes today, not necessarily just in retirement?
Yes. So the big one in terms of today is these traditional 401k contributions. If we've got that at work, we got to think long and hard before not making those contributions. It's just such a great way to reduce our taxes. And you got to remember, we have progressive tax brackets. So what I mean by that is we have a standard deduction, which is effectively a 0% tax bracket. And today it's very high. I think it's $29,200 for a married couple. That's a very high amount. Okay. Then we have a 10% bracket, a 12% bracket, a 22% bracket. Well, during your earning years, what happens is this. You make 401k contributions. The tax benefit isn't at the 0% or 10% bracket. It's at your highest bracket because it comes off the top. So it's the most tax dollars that you'd be putting into that 401k and not paying tax on them. That's part of what makes the 401k so powerful, is you're taking the highest tax dollars and you're saying, don't tax me on them today. Well, wait a minute, I'm going to be taxed on them tomorrow. Yes, but I'm going to go back through the brackets and I'm not going to have that much income to fill up those brackets. So there are going to be some people who take some of that 401k out. Maybe it's in a traditional IRA at that point in retirement, and it's going to be protected by the standard deduction. I call that the hidden Roth IRA, because I'm saying, wait a minute, I'm taking money from a retirement account. I'm not paying tax on it. That's a Roth IRA. No, it's a hidden Roth IRA that lurks inside a traditional 401k. So powerful. But even if it, hey, I have other income, fine. It goes maybe against the 10% bracket, the 12% bracket. Well, if I deduct it at 24 or 32% and I include it back at income at 10%, 12%, 22%, I'm still printing money off the government because I deducted at a rate that's higher than the rate I later included it back into income, right? So that would be the big thing. The other thing about habits and your taxes, and this tends to be more true in retirement than during your working years. In retirement, the income tax tends to look like a consumption tax. So what do I mean by that? A lot of times, one way we can reduce our taxes in retirement is by consuming less, taking less out of our traditional retirement accounts, less out of our taxable accounts. In retirement, the income tax starts to morph and look a little bit more like a consumption tax, not perfectly so. So if we're not spending on things that are just going to go into closets and we're never going to see them again, and it was just a quick dopamine hit, we're actually going to reduce our taxes. So look, I'm not here to say be a miser in retirement. Far from it. I think the 4% rule actually, I think, often makes us too conservative in retirement. So don't be a miser in retirement. But why are we spending for the knickknacks that get dusty, we never see again, and then create a deferred problem for our loved ones when we die? They now have a decision to make. Do I throw this out? Do I sell it? Do I recycle it? Like, why are we doing that when that tends to increase our taxes in retirement? So I think just getting into that habit of like, hey, you know what? I just want to be intentional with my spending. Not that I'm miserly. I think many in the FI community need to avoid miserliness, but also avoid the accumulation of, look at all these closets I got in my house that are packed to the gills, and how often do I use this stuff?
Yeah. Yeah, that's a very good point. Just our habits today, not only is it you're not paying the taxes on that right now, but you're benefiting your future by having other income going to those tax deferred accounts or tax exempt accounts for your future. So yeah, that's a very good point. And I was very inspired by that talk at Camp FI. I believe it was Camp FI Southwest a couple of years ago. You gave that one. Our focus generally is on those who are striving for early retirement. But when we first learned about early retirement, we were gung ho on all the blogs, the podcasts, just like this one. And then, okay, we get the optimized retirement accounts, doing this, doing that, emergency fund, Roth, 401k, thrift savings plan, max out, max out, max out. But we really don't think about taxes that much at that time. Those are all good things to do. But at some point, something in our brain goes, wait, what about taxes? How is tax planning different for those who retire early compared to those who retire at a traditional retirement age?
I would say that for those retiring early, it tends to be incredible, right? It tends to be that much more advantageous. I have a little saying that the federal government, through its tax laws, wants you early retired and it wants you married, right? Now, that said, single people can absolutely get to early retirement and have tons of play in the joints and great tax planning. Let's imagine somebody who retires at age 70, right? So they work through up to their 70th birthday. So they have all this W-2 income, and it fills up their tax return. They have they have fewer planning opportunities from a tax perspective. And then at 70, they have to take Social Security anyway, and it's going to be higher because they worked later. And so they have a situation where the tax planning is going to be a lot more challenging because they don't have years of very low income. Well, you say, well, what about somebody who retires at age 50? Okay, let's think about that person. So they have the high W-2 income in their 40s. We know that. So the tax plan is going to be limited there. Maybe, do your traditional 401k, maybe a backdoor Roth IRA, maybe some charitable giving, fine. But once we get to age 50, now we're retired. We have to think about, well, what would hit our tax return if we're fully retired? Let's just say we're fully retired. Well, we know we can't take Social Security until age 62 at the very earliest. So we're going to have 12 years at least, and probably more, with no Social Security income. Great. Well, okay, maybe we have a small bank account and maybe that generates 4 to 5% interest. That's something, but how much are we going to have in the cash, right? But okay, that's a little bit of income, but not much. And then, we have in our taxable brokerage accounts, we have domestic equities, we have international equities, say. Well, domestic equities, if we look at the broad-based index funds, these days they yield like 1.5%, something like that, right? So how much income? I mean, let's say we had $1 million invested in a taxable brokerage account in retirement, and it's a diversified U.S. index fund. All right, that's $15,000 of income on a $1 million holding. That's incredible. It's how low that is. And then you got to remember that qualifies as mostly qualified dividend income, so it might be taxed at a 0% rate. So that 50-year-old has a tax return that says, hey, I'm poor. Now, they're probably not poor if they're retired at 50, but their tax return says they're poor. So that makes it so much powerful. If we can get to early retirement, tax return without any other planning says we're poor. Well, great. We can now fill up, the standard deduction, the 10% bracket, 12% bracket with these Roth conversions and be cooking with gas, where we're getting that money over out of our traditional retirement account to our Roth account, and it's going to be relatively lightly taxed because we're going to be going up through the standard deduction, the 10% bracket, the 12% bracket. So, for those on the fence in the community, out there listening to the podcast, hey, I'm 53 years old. I just don't know. Should I retire? Should I not? The Internal Revenue Code is saying you probably should, So that's why getting to early retirement can be so much more powerful. But even if we retire in our 60s, we still have opportunities, right? This isn't all or nothing.
I think correct me if I'm wrong, but another benefit of showing little to no income in retirement or early retirement is that you also qualify for other subsidies such as medical coverage.
Yeah, so the premium tax credit. And so that is something, look, by the way, there are people out there, this exists in the world, where they get to 55 or something like that, and the employer pays for the medical insurance for the 10 years between 55 and 65, right? So that exists, but most people in the audience, there's TRICARE, that exists too, but most folks in the audience are probably going to look at an ACA plan if they retire before the age of 65. And what you're alluded to is something called the premium tax credit, where, hey, you know what? If we can keep our income low, we can get a very high premium tax credit against the high premiums. And one of the ways to do that is to have, be taking our money from our taxable accounts instead of, say, traditional accounts. And why do I say that? Well, let's say your living expenses are $100,000 in early retirement. You can use a 401k or a traditional IRA, and it's not even that bad, but pretty much all 100,000 is now income, which could reduce your premium tax credit. Okay. Well, say I don't want to do that because I want more of a premium tax credit. Well, if you lived off 100,000 of a mutual fund in a taxable brokerage account, you just sell the 100,000. Well, what happens there? Well, when you sell it, you're not taxed on 100,000. You're taxed on the gain. So you got to have some basis in that thing. I mean, unless the thing just shot to the moon, right? You got to have 20,000, 30,000, 40,000, 50,000, 60,000 a basis. So the income isn't going to be 100,000. It might be 80,000, 70,000, 60,000, maybe 40,000. So we're keeping our income low by using these taxable accounts, and that keeps our premium tax credit high. And we still may have some room for some good Roth conversions in that scenario too.
So we just focused on the benefits of having, or at least showing, low income. But many people are actually retiring on a high income. It's not, I know there's this, things I hate about the FIRE community, things going around, especially lately, but not everybody in the FIRE community is so frugal that they have to live or decide to live on $23,000 a year. Some are high earners still in retirement. What if a person is a high earner or if they have a pension? How does a high income earner reduce their taxes?
So David, it's funny. Later today, I'll be working on my own YouTube channel. I have a little YouTube channel, Sean Mullaney videos for those in the audience. And
great, good.
I'm going to
link to it.
I'm going to record a video where I've got a 66-year-old married couple where they spend $150,000 a year in retirement. And in that year, they will pay zero federal income tax. And you say, that's a scam, Sean. There's no way. Well, I prove it in the video. I've got a little spreadsheet I'll have in the video. How does that high earner, that affluent couple, reduce their tax or pay very little tax? And in my little video, the main way they do it is through capital gains. Is they say, well, we're going to spend 150, but our gains are going to be 75 or whatever. I'm forgetting the exact numbers in the video that I'm going to make later today. So that's part of the reason I'm forgetting it. But okay. So that's one of the ways that couple winds up paying zero federal income tax, even though they're spending $12,500 a month, right? Think about it. If you spend $12,500 a month in retirement, you're probably going on some nice vacations, yada, yada. So that's a pretty good place to be. So that's one way you can limit your income in retirement. Another way is strategic Roth distributions, right? Financial planners hate taking money out of Roth IRAs. And I'm low, I worry about it because, hey, that's tax-free growth we're giving up. But say, David, someone like you has a military pension or something like that. So the military pension is going to create taxable income. That's my understanding. I don't really work, there's only so many types of people I can work with, and military just hasn't come across my radar. But I'm going to assume, just for the purposes of this conversation, that's a taxable thing.
Sure is.
Yeah. And that's a good problem to have. But maybe somebody like you, and I'm not giving you individualized advice here, but just academically, you should think about this. Maybe somebody like you is taking your military pension and you got a little bit of other income and the YouTube channel's blowing up. And so that's throwing off some income and that sort of thing.
So it's blowing up so big right now.
Yeah, David's got this huge problem now, guys. But keep creating that, hit like and subscribe. But anyway, so let's just say you're coming up to December and you're like, oh, I'm looking at my YouTube income, my military pension, interest, dividends, and hey, I'm on the border of a tax bracket. So maybe I'm just at the top of the 12% bracket or at the top of the 22% bracket or even the top of the 24% bracket. And I need some money to live for December, right? I just need, literally, we got to get some groceries, got a few more Christmas gifts to get. I got the heating bill to pay and all this sort of stuff. So, okay, I got to take some money. If I take it from the traditional retirement account, it's going to increase get me into the 24% bracket or the 22% bracket. I don't want to do that. Well, maybe I take a Roth distribution instead for December. I do that so that I don't slosh over into that next tax bracket, right? Roths are great and we love tax-free growth, but let's use them strategically in terms of our drawdown where, hey, there's some years where our income got higher and we're about to go over that next bracket. why don't we take a Roth distribution tax free? And in most cases, it will be, particularly if we're over 59 and a half in 5 years, it's going to be tax free. But for most Roth distributions from a Roth IRA before 59 and a half, they tend to be tax free too. So let's take a little Roth distribution, use that for our living expenses, and not go into that next tax bracket. And I think for those in the audience with pensions, I think that sort of thinking is going to be very important, because it's going to be harder for you guys to say, oh, I'm just in the 10% bracket, or I'm in the 12% bracket, and I don't have to worry about 22 or 24. When we have a pension, we're creating income. That's just filling up that 0%, 10%, 12% a lot quicker. And we just got to be a little more strategic about it.
All right, I'm going to have a lot more questions on a one-on-one with you at some point, because I pay a lot of taxes. Sean, let's move on to advanced tax strategies and concepts. You have written a book, and I don't know if you know this, but I actually purchased that book.
Thank you for your business. I appreciate it.
Yeah, and there'll be a link in the description for those who are interested. How does a solo 401k plan fit into your overall tax planning strategy, especially if you're a small business owner? And can you define a small business owner?
So the solo 401k is, like my book title says, the solopreneur's retirement account. And by the way, I was at a conference last year and someone claimed, there's a statistic out there, I'm not going to be exactly right, but directionally it's something like there's 28 million businesses in the United States. So that's everything from Apple computers to Sean Mullaney's YouTube channel, right? And everything in between. And of them, 21 million of those businesses have one and only one owner. So that means there's 21 million businesses that should at least be thinking about the solo 401k. Solo 401k is the 401k for those people who own their own small business. And it works a lot like a traditional 401k at a large employer like Apple Computers. But to my mind, it's better for two main reasons. One is you decide the investments and the financial institution, right? So you go to work for Apple Computers, that's fine, but they have their own 401k. Their HR department picks the financial institution, the investments. When you have a solo 401k, you get to go on the internet and do your research of the different financial institutions, the different investments, and you decide which financial institution, which investments. That's great. The second thing is, and one of the drawbacks of being a solopreneur is that it is a great way to pay a ton of taxes, right? Because now you pay both halves of the payroll tax, you pay income tax. Now, the solo 401k doesn't reduce payroll taxes, but it can significantly reduce income taxes when we're working. And, I analogize it again to a large employer 401k. So let's use a round number, $100,000. Say there's somebody who works for a large employer, they make $100,000. And say there's somebody who's a solopreneur and they make $100,000 on, they call it a Schedule C. It's the report. It's the form that reports your income from your business. Okay. So you work for a large employer, you do the $23,000 contribution to your regular 401k, great. And then your employer has probably a small match. So maybe it's a 3% match, 100% up to 3% of compensation. Maybe it's 50% up to 6% of compensation. Maybe it's even a very generous match. It's 100% up to 6% of compensation. So that would be a $6,000 employer contribution. That's great. Okay. Solo 401k is much better, because now the only things you're limited by on the employer side, you get that $23,000 yourself. Okay, great. What do you get on the employer side? Well, you're only limited by the tax law and your cash flow. And the tax law says the limit for about $100,000 is something like $18,500 and a little change. So instead of maybe a $3,000 employer contribution or a $6,000 employer contribution with the same numbers, we're at $18,500 and some change. That's pretty good. And we could tax deduct all that. That's fantastic. When we're self-employed, we got a lot of things on our plates, and retirement savings can be a little complicated. But the solo 401k it's not rocket science. I know that to be true because I wrote a 200-page book about it, right? So it's definitely not rocket science. And it's a very powerful opportunity to reduce our taxes during our working years and build up tax advantage wealth for our retirement. So I'm a big fan of the solo 401k. I like to joke that I'm both a pusher and a user. I have one myself. It's just a very powerful account for a form of employment that is growing. right? In a tech-enabled world, we're just going to see more solopreneurs out there. And so I think we just need to raise visibility and awareness around these solo 401ks.
Now, this might be a completely dumb question, but who is limited? Who can't do a solo 401k?
Okay.
Can a sole proprietor do a solo 401k?
Yeah. And David, that's generally the person it's targeted for, the sole proprietor. Okay. So let's talk about
so you don't have to be an LLC. You don't have to be an S Corp or C Corp. You can be a sole proprietor.
Yes.
And still have a solo.
Yes. So let's talk about who can and can't do a solo 401k. If you don't have a business of your own, so you have a W-2 job, you report every day, great. That's fine. You can't do a solo 401k because you don't have your own trader business. If you're retired, you're fully retired. Well, that's fine, but you can't contribute to a solo 401k because you have no self-employment income. The main requirements for establishing a solo 401k is having a trader business that produces self-employment income to you. And then you have to generally have few, if any, employees. And this varies plan to plan. So if you have no employees other than yourself, you're good, right? But then you have to say, well, wait a minute, I have this part-time employee. Then you got to go through some hurdles, right? And to the extent we have full-time employees, it's going to be very difficult, if not impossible. Full-time is generally defined as 1,000 hours, but can be 500 hours a year if it's, in 2 consecutive years or 2 years. The rules are changing in this regard, but basically it's intended for those whose only coworkers, generally speaking, are their spouse, or maybe they have business partners. Like this can exist with a partnership or an S corporation. And you don't have to have an LLC, but you can have an LLC. You don't have to have an S corporation, but you can have an S corporation. So in the book, I touch on and I go over the eligibility. But it's really for the sole proprietor, colloquially referred to as the solopreneur, but there's some play in the joints there.
Okay. So you said something that confused me just a bit. In my case, I'm retired military. I have a pension. I do some things on the side that could get an income.
Yep.
Would I qualify for a solo 401k?
So what I can tell you, David, is what you have to look at is, do you have a trader business, right? And so trader business requires some level of like to be a trader business for this purpose, you don't have to be Apple computers, right? You don't have to be selling iPhones in 50 states and 100 countries, but you have to have something that looks like a business. You can't just like mow the neighbor's lawn one time for $50 and say, hey, I'm going to open my solo 401k. That doesn't work. But like I said, being a trader business does not exactly require Apple computers level of commerce. So it's a subjective determination. The other thing to keep in mind too is if we're only making like $500, well, the opportunity on the table is like $500 to get into a solo 401k, right? So part of what we want to think about is, well, wait a minute. Yeah, I have some side hustles, but they make me like $1,000 a year. It's like, what are we doing a solo 401k? That's just not going to have much impact in our lives. But like I'm saying, it doesn't need to be the level of Apple computers. I can actually send you for the show notes. There's an IRS website that lists the factors that they look at, which I think is a helpful website for us on the taxpayer side to at least, hey, we've got some factors the IRS is looking at to determine whether we've got a trader business here.
Okay. I'm just writing that down. Sean, one of the things that have been floating on my YouTube algorithm, this gets fed to me, is a strategy that somehow I've dodged it all these years of like even looking at it or finding it, which is hard for me to believe because I, like many others in the financial independence community, have searched and explored the entire web for all of this money stuff. But recently, it seems like every day I get 3 or 4 videos talking about a strategy, and that strategy is called the buy, borrow, die strategy. Can you quickly, I know it's not a simple strategy, but can you quickly as practical, describe what that is, and then let me know and the listeners know if that's something even worth exploring and why it might be or might not be?
Yeah. So what this strategy mostly leverages off of is real estate. And oh, by the way, many Americans tend to use a very small version of this in their own personal finances. I'll come to that. But in theory, what you could do is, let's say, David, you're worth $10 million. Okay, let's just assume that to be true for a second.
Mm-hmm.
Okay. What
Great
what
assumption.
you could do is you could park that money in like rental real estate. So literally you just go buy 10 million of condos or whatever, and that produces an income to you that's very tax advantaged because of depreciation deductions. So you might not pay any tax, or you pay very small tax because of these depreciation deductions on the income generated by $10 million of assets. Think about if you had instead invested that in bonds at 4 or 5%, right? That would have produced 400,000, 500,000 of taxable ordinary income. So it's a great way. Just putting the money in the real estate hides it out from Uncle Sam because of depreciation deductions. So that's one thing we're doing that's really advantageous. But you say, Sean, that rental income, that's not enough for my high flying lifestyle. So what's step two here? Step two is take out some loans on that $10 million of rental real estate. The bank will give you a loan. And especially before we got to 7 8% interest rates, this was very attractive. Oh, I got to pay 2% to the bank. Oh, this is fantastic. So now you're cashing out of that real estate, and you're not paying any tax on it because it's a loan. A loan's not taxable to you. So now you have a way of getting cash, live your lifestyle. You've just borrowed to fund your lifestyle against a real asset, but an asset that also is very tax advantaged by itself. So now you have two sources of cash to live your lifestyle: rental income, which is protected by depreciation deductions, and loan proceeds, which is not taxable. So you've now created tax-free cash flow, which is fantastic. And then you say, well, but at some point we got to pay the piper here. Well, okay, why don't we do this? We die holding this. And all right, so our heirs get 10 million of real estate with a step up in basis. So maybe it grew to 12 million. Well, their basis isn't the 10 you paid, it's 12 million or whatever the fair market value is on your date of death. But there's still debt in this picture, right? Well, all they have to do is on the way home from the funeral, they call their real estate agent and they say, hey, sell one or two of these properties to satisfy the debt. They don't have a capital gain on the property, right? Because they have the step up in basis at your own death. So now they pay off the bank and nobody ever paid tax on any of it. And oh, by the way, in the property they keep, they get to step up the depreciation deductions based on the new fair market value at your death. And now they can repeat it, right? So in theory, this is like, oh, isn't that fantastic? Now it has plenty of drawbacks, right? Including you have to be good at real estate. It's not for everybody. In fact, I'd argue it's not for most people. But what tends to happen during our accumulation years is we tend to do a little mini version of this through our home mortgage, right? So what that home mortgage is doing, technically it's a lien or debt against our primary residence. But what it's really doing is it's opening our runway to invest in the stock market through our 401k, through our taxable brokerage, by not paying down the mortgage sooner than it's 30 years and just even having it for the 30 years. We have more runway to put into the stock market. So we're borrowing from the bank. Yes, technically it's to acquire the house, but functionally money's fungible. So what it tends to do is it allows us to invest more in the stock market that way. So we're doing a mini version of this anyway. I will say though, you should not have the tax tail wag the investment dog. And rental real estate, there's no guarantee you, I, or anyone else will be successful at rental real estate. That's a business. And you have to have knowledge and skill to be good at it.
You mentioned accumulation versus decumulation. And in the buy, borrow, die strategy, would there be a difference if you were trying to accumulate versus, is it decumulate? Is that a word? Decumulate? Deaccumulate?
Yeah. So I decumulation, I've heard that term used at the Bogleheads conference. They talk about accumulators versus decumulators. I think that's like the term mentee. It wasn't really a word, but people just made it up so much. I think it's becoming a word. But anyway, that's a different conversation for a different day. I view this, I think in the FI community, at least in theory, this is more of a strategy in the decumulation phase. And again, I think most people should just look. It's putting everything in the rental real estate basket. We may not even be good at it, so I don't think it's really all that advisable. But what it's trying to do is it's trying to generate tax-free cash flow for your living expenses. For those of us in the accumulation phase who have a W-2 or self-employment, we have the expenses for our we have the cash flow for our living expenses through our work. So the need just isn't really there. I mean, in theory, you could do it, but you're just creating cash flow that you don't really need. So it tends to be more of a conceptual thing in our decumulation phase than our accumulation phase.
Something else I've seen regarding this is even if you didn't have real estate, let's say you had $1 million portfolio, taking an SB lock against that portfolio and then reinvesting that in the market. And as long as you don't get a margin call on that portfolio, then you still basically bank the 2 or 3% difference over time. And that's one way to beat the market, I would think. But to me, that seems like it would be a big risk too, just in case. Of course, it would depend on what you're invested in and how much you're actually withdrawing or taking a loan against, those things. But I'm thinking of what are some ways that even me personally or someone in my situation who's got some net worth, they've got a little bit of time, they might want to put some effort or energy towards something, but don't want an actual job. How can they use their current net worth to continue to build their net worth over time without many more keystrokes? Do you have any ideas for that?
Yeah, David, and you're alluding to what they call margin, right? Which is borrowing on securities. The problem with borrowing on security, first of all, it's highly regulated. There's all sorts of rules around it, and it's highly risky, right? Because, the rental real estate, whatever you want to say about it, it at least has residual value. But margin tends to be around individual equities, and who knows if that company's going to zero, right? Enron went to zero and all this sort of stuff. So, if you borrow to buy Enron and it goes to zero, you got a real problem. You borrow, in part to buy a house. Well, the land has some residual value. The house tends to have residual value. So, I tend to be a simplicity advocate in so many different things, and particularly in our investment life. And look, I'm not here to give anyone investment advice, but, I just tend to say, hey, what are those things that we can do in our investment life that reduce volatility, that reduce expenses, and anything that's getting a little fancy, I sort of question. And I think, if we look at somebody like John Bogle, right, the gentleman who created the index fund, to my knowledge, I think 1975 was the first index fund. We look at J.L. Collins, A Simple Path to Wealth. Sometimes we say, well, wait a minute, simple isn't best. Well, I'd counter to that. Well, simple and best are not necessarily mutually exclusive. You have to do your own analysis and your own thinking, but it's very possible that maybe simple is the best. And so that's sort of the way I like to approach the investment game.
I'm a huge advocate for simplicity as well. Maybe I'm just getting bored and like looking and seeing this. Maybe I'm also getting inspired by these YouTube videos and that I'm seeing. I don't know if it's best or not, but I'm definitely a huge advocate of simplicity, not only just in money, but even in life as well. And it just seems it's a constant effort to get there, but it is one I think worth pursuing. You've said it here in this podcast episode, and I've heard you say it before. You've been known to say, don't allow the tax tail to wag the dog. What does the concept of allowing the tax tail to wag the dog mean? And can you provide examples of how this can be applied effectively in tax planning?
Yeah. So, David, I think most people in the audience should say, I want a portfolio of investments that is appropriate for the level of risk I want to take, my goals for the future. And when they come up with that portfolio, they shouldn't be worried about Roth IRA or traditional 401k or any of that stuff to start, right? Literally come up with a portfolio that, forgetting taxes, what makes sense for you, okay? And I think if we do that, we'll get to a portfolio that we can make work even with the tax planning. So let's step back, right? Rental real estate, right? The folks doing rental real estate are not insane from a tax perspective. It makes a ton of sense, right? And I did an example at Camp Fi a couple weekends ago. So let's say, David, you're sitting on $100,000, okay? You go take that $100,000 and go buy, I'm going to give a ticker here. It's not investment advice for you or anyone else, but you go buy $100,000 of VTSAX. Okay. VTSAX will pay dividends. You'll get taxed on those. Okay, fine, right? The basis that you created does nothing for you. And in fact, may never be relevant. You may leave that to your kids at your death and it'll just get stepped up. And that basis never did anything for you to help your tax picture, right? You have the $100,000 of basis, but it might be totally irrelevant. Or 30 years from now, you sell and the $100,000 is worth so much less because of inflation. Well, okay, so that's one investment option for David Boyer. Second investment option for David Boyer is a condo down the road. Let's imagine it was 100,000, but it's not really going to be 100,000, right? Because what's going to be, it's going to be 500,000. So what you're going to do, David, is you're going to take your $100,000. You're going to go to the bank and say, loan me $400,000. Okay. So now you have a $500,000 condo that you bought with the 100,000, and you get depreciation deductions. And let's assume it's a high rise and there's no material value attributable to land for a second. In most years, you're going to take the 500,000, you're going to divide it by 27.5, and you're going to create an 18,000, whatever that math is, something like $18,000 deduction every year against the rental income you created. So that $100,000 of basis, which did nothing for you in VTSAX, will now generate 18,000 of tax deductions every year for 27.5 years. Okay. That's pretty dang good from a tax perspective. But that said, if the only reason you're doing that is that tax advantage I just pointed out to you, you're letting the tax tail wag the dog. So I think rental real estate makes a ton of sense from a tax perspective, but it's not the only consideration. And you should basically start your investment analysis and picture in a tax-free world and then say, well, how do I make this work considering the different tax situations I have? And I think there are many ways you could do that. One thing I love to do these days is put all our bond investments tend to work really well in like a traditional IRA or traditional 401k. So the bond interest doesn't hit our tax return, that sort of thing. So you can make that work. But just because rental real estate's a great tax play doesn't mean it's the right investment option for you or anyone else.
But don't you think it'd be kind of hard to argue if that $18,000 swing a year isn't helping someone achieve early retirement sooner than they otherwise would?
Well, let's talk about that a little bit, right? So rental real estate can be the right answer, and was more likely to be the right answer when interest rates were 2 and 3%, right? So now we got interest rates at more like 7 and 8%. We've got higher valuations in real estate, and we have less diversification, right? Because instead of buying, a diversified fund, and again, none of this is investment advice for you or anyone else, but instead of buying something that has exposure to all sorts of geographies and industries and sectors and that sort of thing, we're buying a condo, or we're buying 10 condos in the state of Georgia, the state of California, or 5 in Alabama and 5 in Arkansas. I mean, we've got concentrated risk there, right? So it's great that on one metric, the rental real estate's a great thing, but do we want to be paying 7 or 8% interest, right? And the other thing too, so years ago, I went to a Camp FI and Scott Trench from Bigger Pockets spoke, and he had a great point about real estate. He said, as you deleverage the real estate, which is a fancy way of saying paying off the loan, I'm paraphrasing here, but as you pay off the mortgage, your return tends to go down. And it tends to get very, if we have unleveraged real estate, we tend to have very low returns. Now, in theory, if you had 100 doors with no mortgage and it pays your living expenses and you're good at it, fine. Like, who cares that your return is 2%? I'm just giving an example. If it's paying your expenses, great. You go with that, you do you. But that was sort of an interesting observation to me, is that leverage increases risk and increases return on average. But boy, if we don't leverage this thing, our returns might be very, very low. And is that something we really want to do? So, I struggle with the rental real estate game. You got to do you. But I think you just got to remember, it's a business, right? In a way that holding mutual funds is not a business.
Absolutely true. And I do think there's no shortage of real estate gurus out there, and even great ones. I mean, very close friends. You and I both know great people who are advocates for real estate. Chad Carson, Mindy, and Carl Jensen, and many, many others. Great people and very good at what they do. But I also think that if you see that content and think that it's just going to be that easy to go in and get a couple, especially in today's environment, which is very, very tough historically, or at least in the last 20 years, historically tough, then you got another thing coming, especially when compared to how simple and easy, well, maybe not easy, but simple it is just to get a basic understanding of where to put some money that you're earning in some of these tax advantage and tax exempt accounts, and even taxable accounts for all the reasons that you mentioned earlier in this episode. Uh, yeah. So if you're listening to this and you're wondering, say you're 25 years old and you're wondering, should I pursue real estate or maximize my retirement accounts? Usually what I advocate, and I have had real estate. I do own real estate, rental real estate. At my peak, I had 7 properties. I now own 3. I've sold 4 in the last, I don't know, a handful, six years or so, for the sake of simplicity. And I would offer that it is, at least in my perspective, it's much more foundationally solid to focus on that W-2 job if you're one of the fortunate ones out there these days to actually have a solid one. I know that's another whole other topic right now. And then work on that, build up some of those accounts, your taxable accounts, your Roth, your 401k, your thrift savings plan if you're military or a government employee. And then maybe the market does soften over the next few years and you hit 31, 32, and then you have a good reason to add that. And if you think you have a good reason to add real estate to your portfolio at that time, then explore rental real estate. But even in the world of real estate, there's so many options, and there's much more passive options like REITs or REITs than actually owning and operating your own property. So that's kind of like my take on the whole real estate versus way more simple, just direct index fund investing approach. But I've done both throughout my career. How do members of the financial independence community typically think about traditional retirement accounts, and where might they be getting it wrong? You talk about the tax tail wagging the dog. And then you mentioned maybe a misconception of how people use the traditional 401k, or at least perceive the 401k as compared to practical, how it plays out for your clients. What else?
So I think there's at least some in the FI community who are just biting too hard into the Roth apple, right? So what I worry about is maybe if you do everything Roths, okay, and you get to age 56 and you're now early retired. Well, okay, that's fine, right? And if you have enough money, okay, there's nothing wrong with that. But we come back to this premium tax credit you raised earlier, David. And it turns out there's 2 sides to that coin. One of the sides of the coin is this. In order to qualify for a premium tax credit, you have to have a minimum level of income on your tax return. And it's based on state rules of, household size, level of poverty. I think it could be 100%, 138%, 150% of federal poverty level for the household of your size. I know in California, that number today for a household of 4, something like $41,000, something like that. That's real income. Well, okay. If you have everything you own in a Roth account, okay, how do you generate that income? Right? If it's all in a Roth IRA, you have no way to generate income other than going back to work. So I don't like this idea of let's have every last penny in our Roths when, one, we could do very tax-free Roth conversions or very low tax Roth conversions. It might be tax-free, by the way, but at least it will be a relatively low tax. And 2, we're setting ourselves up for some potential failure on the premium tax credit side, because we have to be able to generate at least some income. If we have, $300,000, $400,000 in a traditional retirement account, in addition to the Roth, great. We do these Roth conversions. Just, we look up the federal poverty level that we got to hit to get this premium tax credit. Great. We round up, right? Because we don't want to be $3 short, of course, right? So we round up and we do this Roth conversion. We're going to pay very little tax on that anyway. And now we're going to capture all these premium tax credits. We're doing great. So I'm just worried some people are a little too heavy on Roth these days. And Roth, it has its role in both accumulation and decumulation, absolutely. But we want to make sure we can at least toggle on some income in our early retirement.
You and I went back and forth a little bit before recording this. And one of the topics you said you were passionate about was concepts that might be inadvertently making people in the financial independence community dependent rather than independent. What are some of the things that members of the financial independence community do that actually shift their mindset from being financially independent to financially dependent?
I'm going to give you 3, and I'm actually just writing them down so that I can remember them. All right. First one is medical insurance. I think as this isn't necessarily a FI issue, but I think it becomes a FI issue, right? I believe we over medicalize our problems, right? A lot of our problems probably could be solved through diet, through environmental exercise, not through somebody in a lab coat. Okay. And I think too many in the FI community are too attached to their current employer medical insurance plan. And look, I think everybody needs medical insurance because you or I can be the fittest, healthiest person in the room. We get into a car accident, we're probably going to need some medical attention. Okay. So I'm not saying don't have medical insurance. But I think, especially for the young person in the audience, high deductible health plan. Get used to being the CEO of your own medical and your health, your own health care, your own medical situation. And that way, when you get to early retirement and you say, "Oh no, I can't leave this job because of this medical insurance," you're less likely to say that. You say, "I've managed my own health for so long, an ACA plan is going to work very well for me, and I'm going to be the CEO, the chief cook and bottle washer when it comes to my own health." Okay, so that's one area where I think some people are a little too dependent. And look, I get it. There are people now with chronic conditions, and that's just not going to be a thing. But if we're really young in this audience, I think we want to really take radical ownership of our own health and be less dependent on any one employer's health insurance. Second one's annuities. Okay. So, one thing we're doing when we sign up for an annuity is we are now hitching a big chunk of our financial life to one and only one insurance provider. And you say, well, wait a minute, Sean, isn't there going to be something like the Pension Benefit Guaranty Corporation that's going to protect me? Well, the answer is maybe not. Annuities are protected by a state patchwork. So you got to look at the relevant states involved in terms of, well, wait a minute, I have this financial contract with one and only one one and only one insurance company. What happens if they go belly up? Well, it might be that the backstop in terms of any sort of state protections may not be as robust as you think. There's a paper on SSRN on this. I could send you the link in the show notes for that. I just worry about annuities where, hey, wait a minute, are we really solving for something here? Or are we setting up single party credit risk, right? We're now a creditor of this one and only one insurance company. I worry about that. We're becoming more financially dependent on their finances. I just don't know about that. I'm not here to give you advice as to whether or not to get an annuity, but that is something I worry about. And the last one is long-term care. And long-term care is a challenging situation. But my thinking sort of shifted recently on this question because people worried about, hey, how do I pay for long-term care? And I tend to think that's the wrong question to ask. I think the right question to ask is, how do I avoid long-term care? Why is it a good outcome to wind up in a facility because I can't do one or more activities of daily living, right? Think about that. You're now in a place where you can't do one or more activities of daily living because of deterioration of your own health. Why is it a good outcome to be there, but it's paid for? I don't see that as a good outcome. I think we got to become more independent, and this includes financially, on our own selves to, get our own bodies in good health and, think about what we're putting into our bodies. Are we eating the standard American diet and setting up chronic disease, setting up long-term care? And why is it a good outcome? Oh, well, that's insured, so I'm fine. You can't do one or more activities of daily living. So I'm doing some noodling on this in my own life and my own situation. But those would be three areas where it's like, okay, I hitch my wagon to somebody else, usually an insurance company, and I feel good about it. I'm not so sure we should be feeling so good about it.
I'm very glad you brought up at least two of those topics. One, over my last number of years, and I think I've been like this most of my life, is we've always heard taking ownership. And in the FI community, we usually just, it's a spectrum, but like there's a lot of people who just focus on the money aspect of it. But, there's a Venn diagram of health, money, happiness, all of those things. So thank you for bringing up at least the idea that we should be thinking more than just the dollars when it comes to ownership and our health. The older we get, I don't know your age, I'm 46, but I can tell you I'm in great health for 46, but I am not in perfect health. I've had back surgery and I've taken care of my body. I've never been obese. I've got good genetics. So I'm fortunate in that way. But I say that to say, if somebody's listening to this, no matter what, you have to prioritize your own health. Things will happen, but what you can do is mitigate the downside risk of those things happening to you And financially, you mitigate a big risk by remaining healthy outside. And we're talking in general terms. I'm not talking out, on the outskirts of, instantaneous accidents, auto accidents, and things like that that might cause,
Yeah.
serious issues. Annuities. The episode is doing very well. Christine Benz just published this last Wednesday. But in that conversation, and definitely after that conversation stopped recording, she and I got into it about annuities. And she is a brilliant person. And other brilliant people like Paul Merriman and I have had conversations about annuities. And I just can't get over the hurdle that they're a good thing. They think they advocate for them. And while I at its face, I just can't. And I don't know if that's my lack of knowledge or just maybe goes back to the direct ownership thing. I have a problem giving the ownership away. If I have $500,000, why would I give that to somebody else to manage? I've just managed that money my entire life, and I'm more confident in my ability than somebody I can't see or control or influence. I understand the basic trade-offs, but I think annuities is something either I'm missing out on parts of it. Maybe there's a spectrum of annuities where some are more vanilla and less fees, maybe more regulations about particular annuities to protect the buyer, that kind of thing. I don't know what you're seeing in your experience or with your clients, or even if you advocate. Can you say you even advocate or don't advocate annuities?
Look, I'm not here to give advice to any person, but I tend to think that annuities increase expenses, increase single party creditor risk, right? We're now taking on a creditor risk we don't have to take if we do mutual funds, ETFs, that sort of thing. The other thing I don't like about annuities is this. How often do the people talking about annuities start the conversation this way? Do they ever say, hey, David, you're an American. You've built up a Social Security earnings record. So you already have an annuity, right? Think about this. Most Americans have one, if not two, because they're married, or even maybe they've got there's a such thing as divorce benefits when we have Social Security too. So most Americans have one or possibly two annuities already. Social Security is an annuity. So they never start the conversation by saying, hey, David, you already have one of these things, but let me tell you why you need a second one, right? That would be a more robust, intellectually honest way of starting that conversation. It's sort of like, Dave, if I worked at Best Buy and I walked into your living room and I see David's got 100-inch big screen TV, best picture you ever saw, and, great sound, the whole bit, you would think a little odd of me if I said to you, David, you need another 100-inch big screen TV for this living room. Now, there could be a use case. You could say, hey, Sean, I happen to be the world's biggest SEC football fan. Every Saturday, I want 2 games on my, okay, great. We now have unique facts. We have a unique use case for a second big screen TV. How many people got this unique use case for a second annuity in their life, right? Now, one argument I've heard for them is, well, what happens is people get worried. People say, I'm going to run out of money, so I'm not going to take the trip to the tropics. I'm not going to fly first class. Well, my counter to that one is those people are letting emotions govern, not letting reason govern. And maybe we need to all work on being governed by our emotions a little less, right? But 2, there are people who get the direct deposit from Social Security and don't spend it. So you're telling me they're going to now get the direct deposit from the annuity and they're going to spend that though, right? Just because something might trick, people into spending more doesn't mean 1, they should need to be tricked, or 2, it will even be effective. Maybe it won't be effective. Maybe they're going to get that annuity payment and be like, well, I can't spend that. I need that money. So
Yeah.
I'm sort of with you, David. I really struggle with them and this issue of we're increasing risk, right? What happens if this insurance company goes under? And it may be that the state patchwork in terms of protecting annuitants isn't as strong as we think. Hasn't really been tested. Look, I'm not here to raise oh my goodness, I have an annuity. I've got this huge problem. The odds are that your lived experience is going to go just great, right? That's the odds, no guarantees. But why are we taking on this single party credit risk when it may be solving for a problem that we don't really have?
Yeah. the very last statement you said, we might be solving for a problem we don't really have. It takes me back to like military planning. Very first thing you have to come up with so that your efforts are actually in alignment is you have to create a problem statement. And if this doesn't happen, this is a likely outcome, and then work backwards from there. And maybe that is what we need to start focusing more on, these types of conversations. And even at campfires, when you're sitting around having a couple drinks, like let's focus on what is the objective? What problems are you having? And then go back rather than just a blanket. Everybody needs rental properties. Everybody should, even though I really firmly believe this for the majority, people should just funnel money into low cost broad market index funds forever. Or whatever that is, that's seems to be streamlined as far as the messaging in circles. But fundamentally, in our lives, we're solving for a problem, and we have to know what that problem is and then work backwards from that. So thanks for putting that in that perspective. For me, the issue with annuities is when you die, it goes away. It's no longer in your, unless you have some kind of special circumstance or something, which I'm not educated on annuities enough to know, but the basic, as I understand it, you buy it, you trade, give somebody your money, you get some payments until you die, then your heirs get zero, basically. So I'm sure there's like maybe exceptions to that out there, but that's the problem I have with it. If you've managed your money, I can say it like this. If you're a proponent of the financial independence movement or understand personal finance, all that stuff, you understand the 4% rule. That, to me, that's building your own annuity. You've just built your own annuity and you have complete control over it. So why not just look at it like that and then completely forget? That way the ball's always in your court.
David, it's interesting. You make a great point. There's a gentleman on YouTube. I think he's called Stan the Annuity Man. And he does some great content. I think he has a ton of subscribers on YouTube. And, he made the point I made about Social Security, and he added to it. He said, well, Americans also have these so-called required minimum distributions from their traditional retirement accounts. And he viewed those as an annuity. Now, I sort of disagree, but, I think there's some merit to that thinking. And then back to what you're saying in terms of, are we really solving a problem here? Or is there another simpler way that doesn't involve paying an insurance company and taking on single party credit risk?
Yeah, we won't get into it now, but just you throwing that out there made me think of how much of a role philosophy plays in this. There's people out there who think, die with zero is the way to go. And then there's people out there who want generational wealth. And the two may not be completely, mutually exclusive, but I think depending on the philosophy that you follow, that might influence on these types of decisions that we're talking about, annuity or no annuity, that kind of thing. So moving on, Sean, you are always at the forefront of not only, I'm sure, the tax code for your work, but you are also in the forefront of the financial independence community and the issues that affect us. The Tax Cuts and Jobs Act of 2017 is set to expire by 2025. Do you think these provisions are going to be extended? It's an election year, who knows? But if so, is that a good idea? And why do you think so?
All right, so I have a little saying. There's nothing more permanent than a temporary tax cut. You have to remember why it was a temporary tax cut. It was passed in late 2017. And like you're saying, David, according to current law, it expires on New Year's Day, 2026. I strongly think most of it will not go away. And I think it's also a good idea to preserve most of it. It's been very beneficial for the financial independence community, particularly in the retirement phase. Well, so why do I say that? Well, it increased the standard deduction. And that's a big part of what makes financial independence, tax planning, very powerful right now. Is get to early retirement, you have that high standard deduction, you essentially have a very high 0% tax rate. I think that will get extended. If that didn't get extended, that's a big tax hike on millions of Americans, and it would hurt the poorest workers the most. So I think politically it's unpalatable to not extend it. That's my opinion. You do you. I think one thing that's really helped in the financial independence movement, we have so many solopreneurs, there's something called this qualified business income deduction. That came in the Tax Cuts and Jobs Act. That's temporary. I think that will get extended. In fact, a few years ago, the Democratic, so Tax Cuts and Jobs Act was mostly, it was President Trump, mostly Republicans. Might have been all Republicans for all I know. You go back and look on thomas.loc.gov or whatever. But essentially it was a Republican tax cut bill. I believe it was in 2021, a gentleman named Ron Wyden, who's a senator, a Democrat from Oregon, uh, proposed his own version of the qualified business income deduction. I was very happy to see that. So that said, oh, well, Democrats are sort of on board for a version of this. Either way, the FI community is going to benefit from that. So I think the QBI deduction, that qualified business income deduction that most solopreneurs get, that will get extended. Something it was the 15% became the 12% bracket. That very much helps in retirement planning. I think that will get extended. Now you might say, hey, Sean, I disagree with you. I think the Tax Cuts and Jobs Act is not going to get extended. If you thought that, you might want to do something like delaying charitable contributions, right? Because you think in 2026, the tax rates are going to go up. If your income is the same level, it might be better to take the charitable deduction in 26 or later than in 25. Again, I think most of it will get extended. Maybe not every last piece of it, but I do think most of it will get extended. And if I was in the audience, I wouldn't have this be like a fundamental driver. It's fun to talk about, but I wouldn't have it be a fundamental driver of my financial independence planning, my tax planning.
Whether it be in the media, YouTube, other podcasts, inside financial independence community, or at large, do you see any tax trends right now that are either becoming more popular that you think is pertinent for us to do some more exploration?
So one thing I'll mention to you, David, is if you look at, this isn't necessarily financial independence, more personal finance. If you look at a lot of the personal finance content creators, there's a lot of fear about, oh no, the federal government's got this huge debt and deficits, and so taxes are going to go up. And so what they're saying is, well, retirees, you better look out. You're going to get these traditional 401ks, traditional IRAs are going to get taxed to oblivion. Well, I say a couple things about that. One is we have to look at what Congress has actually done in recent years. And I've laid this out. Congress in the last, decade or so has enacted four different tax cuts for retirees. They keep cutting taxes on retirees. The U.S. Treasury got involved. The RMD table got more generous to retirees. So the prediction is taxes are going up on retirees. The lived experience is Congress is always getting in there and tinkering and just, we're going to cut taxes just a little more for retirees. And now we're going to cut taxes a little more for retirees. So I think the lived experience has demonstrated, boy, Congress seems to like to cut taxes on retirees. Retirees tend to vote. And you also have to look at the political incentive, right? The political incentive is for Congress to keep rewarding retirees. The other thing is, Congress leaves a lot of money on the table, right? There's other mechanisms that can create tax revenue in the future that don't have to tax retirees, right? Other than very, very, very affluent retirees, right? If I'm Aaron Rodgers and I'm thinking about my retirement and I'm going to be at the top bracket because I'm going to have endorsement deals and Hollywood deals and broadcasting, then yeah, I might be a little concerned about the future of tax rates. But if I'm in the FI movement, I'm not anywhere near as concerned about the future of tax rates in retirement.
Sean, thank you so much for all of that information today. Is there anything else you'd like to add?
No, David, I think you and so many others are doing great work, just having these conversations. We all have to come up with our own decisions. And it's not about, I found Sean Mullaney or Paul Merriman or J.L. Collins or whoever it is, Brad Barrett, David Boyer. It's not, I found so-and-so and they're always right. It's, interesting. Paul Merriman's making this argument. Brad Barrett's making that argument. Mindy Jensen's making a third argument. Great. Let me critically assess it and come up to my own decisions and say, oh boy, Mindy on these 3 points was totally right. And I dug in and that's why I agree with her. Not because, Mindy said or Sean said or David said. That's great. But that by itself is not how we make our decisions. And I think sometimes in the FI community, we get a little too, so-and-so has a big platform that, and so I'm just going to follow them. No, step back and say, hey, nobody's perfect. Let me do my own analysis. And I think we could all figure out good paths for each of us.
Yeah, thank you, Sean. I think that goes back to the earlier sentiment of, take ownership. As soon as you align yourself too much with other people for the sake of just doing that, then you're giving that ownership away and you're giving that power away. You want to own all of that. And that way you get the credit and you're also responsible for maybe the not so great things. But over time, that's a much more powerful and empowering way to go forward. Thank you, Mr. Sean Mullaney, for sharing your valuable knowledge and tax planning strategies, especially tailored to those who are pursuing financial independence and early retirement. It's clear that effective tax planning can make a significant difference in achieving our financial goals, but they should not wag the dog. And thank you all for watching and listening.